The conference room is silent. 23 central bankers sit around a table in Basel, Switzerland, their faces illuminated by the cold glow of laptop screens displaying numbers that shouldn't exist. Outside, the Alps stand indifferent to what is about to unfold. Inside, someone clears their throat. The sound echoes. A woman from the Federal Reserve leans forward, her voice barely above a whisper, and asks the question everyone has been avoiding for 18 months. What happens when the collateral disappears? No one answers, because everyone already knows. The global banking system, that invisible architecture holding together every mortgage, every salary, every pension, every dream of security you've ever had, is built on a foundation that is quietly crumbling. And the people in this room, the architects of money itself, have just realized they cannot stop what is coming. This is not a story about speculation. This is about mathematics, incentives, and the terrible momentum of systems designed to function in a world that no longer exists. What you're about to hear is not a prediction. It is an observation of forces already in motion, of decisions already made, of consequences already unfolding in the shadows of algorithms and overnight lending markets that most people will never see. The crisis of 2026 will not announce itself with a crash or a panic or a dramatic plunge in stock prices that makes headlines. It will arrive quietly, almost bureaucratically, as a series of technical adjustments that sound boring until you understand what they actually mean. It will feel, at first, like nothing at all. And that is precisely what makes it so dangerous. Here is the question that will define our financial future. The moral and intellectual paradox that every economist, every regulator, every person with a savings account will soon be forced to confront. When the institutions designed to protect stability become the very mechanism of its destruction, when the safeguards themselves turn toxic, when doing nothing becomes more dangerous than risking everything. What then? Do we preserve the system and accept collapse? Or do we tear it down and face the chaos of reinvention? This is not theoretical. This is the choice being made right now. In meeting rooms you'll never enter, by people whose names you'll never know, and the consequences will reshape your life whether you pay attention or not. The crisis of 2026 is not coming because of greed, though greed will play its part. It is not coming because of incompetence, though incompetence will be everywhere. It is coming because the global banking system has become a machine that can only function by consuming increasing amounts of the very thing that is running out, trustworthy collateral. And when that collateral vanishes, when the bedrock of lending and borrowing and credit turns to sand, everything built on top of it will have nowhere to go but down. To understand how we arrived at this precipice, you must first understand what happened in the years after the world decided it could not allow banks to fail. It began in 2008, when the financial system came within hours of complete annihilation. You remember the headlines. Lehman Brothers, AIG, the Great Recession. What you might not remember, what was barely discussed even then, was the philosophical revolution that followed. Governments around the world made a choice. Banks were too dangerous to die. The risk of letting them collapse, of allowing the dominoes to fall naturally, was deemed unacceptable. So central banks did something unprecedented. They flooded the system with liquidity, buying up trillions in assets, pushing interest rates to zero and then below zero, creating new money not through lending but through declaration. They called it quantitative easing. It was in essence a promise. We will not let you fail. But promises in finance always come with a price, and that price is always paid later with interest. For more than 15 years, the world's major economies operated under emergency protocols that were never meant to become permanent. Interest rates stayed low. Asset prices inflated. Real estate, stocks, bonds, everything rose because money was cheap and abundant. People called it a recovery, a new normal, a sign of resilience. But beneath the surface, something else was happening. Banks, those institutions that are supposed to allocate capital efficiently, connecting borrowers with lenders, facilitating growth, had become something different. They had become dependent on central bank support, dependent on government guarantees, dependent on the assumption that the music would never stop. And then came 2022. Inflation, that old ghost everyone thought had been exorcised, returned with a vengeance. The causes were complex: pandemic supply chain disruptions, energy shocks, fiscal stimulus colliding with constrained production, but the effect was simple. Prices rose faster than they had in 4 decades. Central banks panicked. They had spent 15 years promising that money would stay cheap, and now they had to break that promise. Interest rates began to climb. First slowly, then rapidly, then relentlessly. The Federal Reserve raised rates 11 times in 18 months. The European Central Bank followed. The Bank of England, the Bank of Canada, even the Bank of Japan, which had spent 30 years fighting deflation, began to shift. And with every rate increase, something fundamental changed in the architecture of global finance. Bonds, those supposedly safe investments that pension funds and insurance companies and banks themselves hold as bedrock assets, began to lose value. It sounds technical, but the mechanism is brutally simple. When interest rates rise, the value of existing bonds falls. A bond paying 2% interest becomes worthless when new bonds pay 5%. And suddenly, trillions of dollars in assets that banks counted as safe, as stable, as collateral, were worth far less than anyone wanted to admit. This is where the story gets dangerous. Because banks, under international regulations created after 2008, are required to hold certain amounts of high-quality liquid assets as protection against crises. Government bonds, AAA-rated securities, the safest stuff in the world. But safe is a relative term, and when interest rates move violently, nothing is truly safe. Banks around the world found themselves holding assets that, on paper, were worth billions less than they had been a year before. Some banks disclosed these losses. Most did not, because the accounting rules allowed them to pretend the problem didn't exist as long as they didn't sell. It's called held-to-maturity accounting, and it is a beautiful piece of regulatory fiction. You can own something that has lost half its value and claim it's still worth full price, as long as you pinky swear you won't sell it. This works perfectly until the moment you need to sell. If stories like this fascinate you, the untold mechanisms behind the headlines we're fed, consider leaving a like. It helps surface the kind of deep analysis that doesn't fit into a 60-second news cycle, and it tells the algorithm that complexity still matters. March 2023 was the warning shot. Silicon Valley Bank, the 16th largest bank in America, collapsed in 48 hours. The mechanics were textbook: a mismatch between assets and liabilities, a bank run accelerated by social media, and underneath it all, a portfolio of government bonds that had lost billions in value because of rising interest rates. Regulators seized the bank on a Friday morning. By Monday, depositors at other mid-sized banks were pulling their money out, terrified they might be next. Signature Bank failed. First Republic Bank teetered and was ultimately absorbed. For a few weeks, it seemed like 2008 might repeat itself. But this time, the government moved faster. The Federal Reserve created an emergency lending program, offering to buy banks' underwater bonds at full face value, pretending the losses didn't exist. Depositors were made whole. Panic subsided. Markets stabilized. Everyone exhaled and declared the system had worked. But that was not what happened. What actually happened was that the authorities revealed their hand. They showed that they would do whatever it took, including suspending basic market principles to prevent bank failures. And in doing so, they confirmed what everyone suspected but few wanted to say out loud. The banking system is too fragile to withstand normal market forces. It exists now in a state of permanent emergency, kept alive by interventions that grow more extreme with each crisis. And every intervention makes the next crisis both more likely and more severe. Now we arrive at the present, at the exact moment when the architecture begins to buckle. Look around the global financial system today, late 2025 as we record this, and you will see a landscape transformed. Commercial real estate, particularly office buildings in major cities, is in free fall. Remote work, that pandemic innovation that was supposed to be temporary, has become permanent. Office vacancy rates in cities like San Francisco, London, and Tokyo are at historic highs. Buildings worth hundreds of millions are being sold for a fraction of their value, or simply abandoned. And who owns the debt on these buildings? Banks. Who holds the mortgages and the construction loans and the refinancing packages? Banks. The losses are staggering, but they are being absorbed slowly, quietly, one write-down at a time, so as not to alarm anyone. Meanwhile, sovereign debt has exploded. Governments that spent trillions fighting the pandemic now face trillions more in interest payments as rates have risen. Italy's debt-to-GDP ratio has crossed 150%. Japan's is over 260%. Even the United States, with the reserve currency and the deepest capital markets, is now paying more in interest on its debt than it spends on defense. The bond markets, those vast and supposedly stable pools of capital, are beginning to crack under the weight. And here is where the collateral problem becomes existential. Banks are required to hold high-quality assets. In practice, that means government bonds. But what happens when government bonds themselves become questionable? What happens when the assets you're required to hold for safety become the source of risk? You get a paradox with no solution. You get a system that cannot be fixed from within. At the same time, the shadow banking system, that parallel universe of hedge funds and private equity and money market funds that operates with all the risk of traditional banking, but none of the oversight, has grown to dwarf the traditional banking sector. These institutions are deeply interconnected with banks through derivatives, through repo markets, through 1,000 invisible threads of leverage and obligation. When something breaks in the shadow system, it instantly infects the traditional system. And the shadow system is fragile in ways that regulators barely understand and cannot control. They see pieces of it, glimpses in quarterly filings, but the full picture is obscured by complexity and secrecy. One major hedge fund collapse, one unwinding of a massive derivative position, one sudden shift in liquidity, and the contagion could be instant and unstoppable. This is not speculation. In September 2024, a mid-sized British pension fund group nearly triggered a systemic crisis because of leveraged derivative positions tied to government bonds. The Bank of England had to intervene with emergency bond purchases. The crisis was contained, but it revealed just how close to the edge the entire system operates at every moment. We are living inside a financial architecture held together by interventions, by emergency measures that have become routine, by the faith that central banks will always step in. But faith is not a stable foundation, and the interventions themselves are running out of room. Let me take you inside what is happening right now, what the bankers in Basel and Frankfurt and Washington are seeing in their models and their overnight reports. The repo market, that essential plumbing system where banks and institutions lend to each other using collateral, is showing stress. Not the dramatic stress of a crash, but the subtle stress of a system that no longer quite trusts itself. Repo rates spike unexpectedly. Collateral requirements tighten. Certain types of bonds that used to be universally accepted are quietly being rejected. Banks are hoarding cash and high-quality assets instead of lending them out. This is called liquidity preference, and it is what happens when institutions sense danger but cannot quite articulate what the danger is. Meanwhile, the Basel III endgame regulations, those final pieces of post-2008 reform that are supposed to make banks safer, are being implemented now, in 2025 and into 2026. These rules require banks to hold even more capital, even more high-quality liquid assets. On paper, this makes the system more resilient. In practice, it forces banks to hoard precisely the assets that are becoming scarce and questionable. It creates a vicious cycle. Banks need more safe collateral, but safe collateral is losing value. So banks hoard it, which makes it scarcer, which makes the system more fragile. The regulations designed to prevent the last crisis are creating the conditions for the next one. And then there's China, the world's second largest economy, the engine of global growth for 2 decades, is experiencing a slow-motion banking crisis of its own. Property developers have defaulted on hundreds of billions in debt. Shadow banks have collapsed. Local governments are insolvent. The Chinese Communist Party has responded with massive liquidity injections and forbearance, allowing banks to hide losses and extend bad loans indefinitely. It has worked so far in the sense that there has been no dramatic collapse. But the debt is still there, growing, metastasizing. And China's banks are deeply interconnected with the global system. When the containment fails, and it will fail because mathematics always wins, the shock will propagate instantly across borders, through currency markets, through commodity prices, through the balance sheets of every multinational corporation and every pension fund with Chinese exposure. The question is not whether it will happen. The question is whether it happens before or after the Western banking system reaches its own breaking point, and whether the two crises will collide or cascade. Now let me describe what 2026 looks like, what the crisis will feel like as it unfolds. It will not begin with a bang. It will begin with a technical announcement from a central bank, probably the Federal Reserve or the European Central Bank, about adjustments to collateral requirements or liquidity facilities. The announcement will use language like enhancing system resilience or updating operational frameworks. Financial journalists will file stories that most people will not read. Markets will barely react. But inside the system, inside the banks and the hedge funds and the trading desks, people will understand what the announcement actually means. The authorities are preparing for something. Within weeks, other signs will appear. A regional bank in Europe will quietly merge with a larger institution. The deal announced as a strategic combination, with no mention of insolvency. A pension fund will suspend withdrawals temporarily, citing market volatility. A country you've never thought much about, maybe Hungary or Portugal or New Zealand, will face a sudden debt crisis, needing emergency support from the IMF. Each event, taken alone, will seem manageable, containable, unrelated. But they are not unrelated. They are symptoms of the same underlying disease. The collateral base of the global banking system is eroding, and the institutions dependent on that collateral are beginning to fail. Then comes the acceleration. A major bank, probably in Europe or Japan, will report losses far larger than expected. The stock will plunge. Regulators will rush to reassure everyone that the bank is solvent and the system is sound. But depositors will not be reassured because they learned in 2008 and again in 2023 that reassurances often precede disasters. Deposits will begin to flow out of vulnerable banks and into the largest, most systemically important institutions. This is rational behavior for each individual depositor, but collectively it is catastrophic because it concentrates risk in exactly the banks that are too big to fail and too big to save. Governments will face an impossible choice. Let the smaller banks collapse and trigger a cascade of panic, or intervene with bailouts and guarantees that further destabilize sovereign debt markets. Either way, the crisis deepens. And here is where the collateral trap becomes a noose. Central banks will try to provide liquidity, to lend against the underwater assets that banks hold, to keep the system functioning. But this creates new problems. Every emergency loan, every liquidity facility, every asset purchase program increases the central bank's own balance sheet, making it more vulnerable, more exposed. At some point, the central banks themselves become part of the problem. Markets begin to question whether the Federal Reserve or the ECB or the Bank of England can actually absorb all the losses, whether their own solvency is at risk. This sounds impossible because central banks can print money, but printing money has consequences. It destroys the value of the currency. It ignites inflation or hyperinflation. It turns a banking crisis into a monetary crisis. This is the nightmare scenario, the one that keeps the bankers in Basel awake at night. A crisis so large that even the central banks cannot contain it without destroying the currency itself. At that point, trust evaporates. Not just trust in banks, but trust in money. And when trust in money disappears, economies revert to barter, to gold, to chaos. The fallout from the 2026 crisis will not be a single dramatic event, but a grinding transformation that unfolds over years. In the immediate aftermath, there will be bank failures, consolidations, emergency nationalizations. Governments will seize control of institutions deemed systemically important, turning private banks into de facto public utilities. This will be sold as temporary, as necessary to protect depositors and maintain stability. It will not be temporary. Once governments control the banks, they will not let go, because banking is too important and too dangerous to leave to the market. The age of private banking, that centuries-old model where institutions operate for profit while bearing risk, will effectively end. What replaces it will look more like the systems that exist in China or Singapore. Banks as instruments of state policy, lending not based on profit but on political priorities. This will have profound effects. Credit allocation will become centralized. Access to loans will depend not on your creditworthiness, but on whether your project aligns with government objectives. Entire industries will be starved of capital because they are politically disfavored. Other industries will be flooded with cheap credit because they are strategically important. Efficiency will decline. Innovation will slow. But stability, that elusive goal, might finally be achieved because when the state controls banking, it can forbid failures by decree. At the same time, the crisis will accelerate the fragmentation of the global financial system. The era of free capital flows, of integrated markets, of a single global banking system, will fracture along geopolitical lines. China will decouple further, creating a yuan-based financial sphere in Asia. Europe will turn inward, prioritizing internal stability over global integration. The United States will weaponize the dollar, using financial infrastructure as a tool of foreign policy, which will only accelerate the desire of other countries to escape dollar dependence. We will move toward a world of regional financial blocks, of currencies and banking systems that operate in parallel, but not in cooperation, of capital controls and barriers and suspicions. This will make the world poorer, less efficient, less innovative. But it will also make crises more containable, because contagion cannot spread across borders that are sealed. The choice will be global prosperity with systemic fragility or regional stability with diminished growth. And in the wake of 2026, stability will win. For individuals, for you, the consequences will be immediate and personal. Your savings, if held in bank accounts, will be subject to new restrictions, withdrawal limits, negative interest rates, forced conversions into government bonds. This will be justified as necessary to prevent bank runs, to maintain stability, to protect the system. In reality, it will be a quiet confiscation, a way for governments to access your wealth to shore up their balance sheets. You will be told you are being patriotic, that you are doing your part to save the economy. You will have no choice. Your mortgage, if you have one, may be subject to sudden adjustments. If your bank fails and is nationalized, your loan terms could be rewritten. Interest rates could change. Forgiveness programs could be implemented or denied based on political criteria. The sanctity of contracts will be subordinate to the needs of the system. Your employment will be affected as credit contraction hits the real economy. Small businesses that depend on revolving credit lines will close. Projects will be canceled. Hiring will freeze. Unemployment will rise, not to Depression-era levels, but enough to create a new normal of economic anxiety and diminished expectations. The middle class will shrink further as wealth becomes more concentrated among those who own hard assets, real estate, and equities, while those dependent on salaries and savings find their purchasing power eroded. And then there is the psychological toll, the shift in how people understand money and security in the future. An entire generation grew up after 2008 believing the system could be saved, that central banks were omnipotent, that crises could always be managed. The 2026 crisis will shatter that belief. People will learn that the institutions they trusted, the banks and the regulators and the governments, are not in control, that the system is not resilient, that the guarantees are not guaranteed. This will produce a profound cultural shift towards self-reliance, toward tangible assets, toward distrust of authority. Bitcoin and other cryptocurrencies will surge in popularity, not because they're good investments, but because they represent an escape from a system that has failed. Gold will soar. Property in stable jurisdictions will become a haven for wealth. Capital flight will accelerate as those with resources seek to protect them outside the banking system. The social contract around money, that collective agreement that these pieces of paper and these digital entries have value, because we all believe they do, will weaken. And once that contract weakens, once doubt creeps in, it is extraordinarily difficult to restore. But here is the deeper legacy, the question that will define the decades after 2026. What kind of financial system emerges from the ruins? There are two paths, and the choice will be made not by conscious design, but by the messy collision of crisis, politics, and necessity. The first path is centralization. Governments, having seized control of banking, will expand that control into every corner of finance. Central bank digital currencies will replace cash, allowing authorities to monitor and control every transaction. Privacy will be sacrificed for stability. Credit allocation will be politically determined. The system will be safer in the sense that panics and bank runs will be impossible, but it will be less free, less dynamic, less innovative. This is the path toward a managed economy, toward a world where financial decisions are made by technocrats and politicians rather than markets. It will be sold as progress, as the solution to the chaos and inequality of the old system. Many people will embrace it, exhausted by crises and willing to trade freedom for security. The second path is decentralization. The collapse of trust in traditional banking will accelerate the shift toward alternative systems. Cryptocurrencies, decentralized finance, peer-to-peer lending, systems built on blockchain technology that operate outside government control. This path will be chaotic and risky, full of scams and failures and volatility. But it will also be innovative, resilient in a different way, impossible to shut down because it has no center to attack. Wealth and power will flow to those who understand these new systems, while those who cling to the old ways will be left behind. This is the path toward a fragmented, experimental financial landscape, where innovation and danger coexist, where individuals bear more risk but also have more freedom. Most likely, the future will be some hybrid of these paths, a patchwork of centralized and decentralized systems coexisting uneasily, competing for legitimacy and adoption. The world will not choose one path cleanly. Different countries, different communities, different generations will make different choices. And that fragmentation itself will define the post-2026 era, a world where financial systems are plural, where money means different things in different contexts, where the old assumptions about banking and credit and stability no longer hold. This is not necessarily worse. It is simply different. And whether it is better or worse will depend on how we navigate the transition, on whether we learn the right lesson from the crisis or simply repeat the old mistakes in new forms. So let me return to that conference room in Basel, to those 23 central bankers staring at impossible numbers. They knew this was coming. Not the specifics, not the exact timing, but the inevitability of it. You cannot run a financial system on emergency measures forever. You cannot inflate asset prices indefinitely while suppressing interest rates and expect no consequences. You cannot promise that banks will never fail and simultaneously expose them to risks they cannot manage. You cannot build a global economy on debt and leverage and collateral that loses value and expect it to hold. The mathematics always catch up. The crisis of 2026 is not an accident. It is the logical endpoint of 15 years of choices, of interventions that solved immediate problems by creating larger future problems, of kicking the can down the road in the hope that somehow, someday, the contradictions would resolve themselves. They will not resolve themselves. They will explode. And when they do, everything will change. The question posed at the beginning, the moral and intellectual paradox of this moment, remains unresolved. When the institutions designed to protect stability become the mechanism of its destruction, what do? Do we cling to the old system, accepting its flaws and its risks, because the alternative is unknown and terrifying? Or do we tear it down, embracing chaos and uncertainty in the hope that something better emerges? There is no right answer, only choices and consequences. What we are witnessing is the end of one era of banking and the painful birth of whatever comes next. History will call it crisis. But those who lived through it will know it as something more, a reckoning, a moment when the gap between how we pretended the system worked and how it actually worked became too large to ignore. The 2026 crisis will end banking as we know it not because of some external shock, not because of war or natural disaster or a singular villain, but because the system itself, in its current form, is no longer viable. It has become too complex, too interconnected, too dependent on interventions, too laden with contradictions. It must transform or it must collapse. And transformation, true transformation, is only possible after collapse. What would you have done if you were sitting in that room in Basel, staring at those numbers, knowing what was coming, knowing that every choice would be wrong in some way? What would you have done if you were the regulator, the central banker, the person whose job it is to prevent the disaster that cannot be prevented? Tell me in the comments, because this is not just a story about bankers and regulators and distant institutions. This is about systems we all depend on, about the invisible infrastructure that makes modern life possible. And when that infrastructure crumbles, we all feel it. If you crave more stories that pull back the curtain on the mechanisms of power, that explore the hidden forces shaping our world, that refuse to accept simple explanations for complex realities, then subscribe. Because the next crisis is always forming, the next transformation is always building. And those who understand what is happening beneath the surface will be the ones who navigate what comes next. The 2026 crisis is not the end of the story. It is the beginning of a new chapter, one we are all about to write together, whether we are ready or not.